Rainbows to Riches.
Welcome back to Rainbows to Riches, guys, your favorite podcast on personal finance. I'm Rayleigh, and until recently, I had absolutely no financial guidance until I met Drew at the gym, and through him, I met Michael, his husband. And long story short, we not only became close friends, but they also became my financial mentors, and we decided to spread that with the world.
I'm Drew. I've run a number of different businesses over many, many years, and I have bought, sold, and rented out both commercial and real estate properties.
I'm Michael. I'm Drew's husband. When I first met him, I had just come through bankruptcy, and with his help, I was able to make some financial investments, buy my first house, and open a business. Now we're looking at potentially retiring in the next couple of years.
Period. And today we are going to be continuing last week's episode. Do you guys remember what we were talking about last week?
Talk about stocks and bonds and mutual funds.
Period. So we are going to talk about the risks.
You asked that because you didn't know what we were
I did know.
Okay.
I did know all of
Just
them. I was just testing you.
Okay.
Period. So today we're going to continue our conversation from last week. And we'll talk about the risks of these investments and also how to initiate them, how to start safely investing. So, Mr. Drew, all investments carry some sort of risk, right?
That's the main point, and that's what everybody has to remember, that there is no investment with zero risk, really none. There are some that come very, very close to zero, or not many. And most have some degree, whether it's market risk or credit risk, interest rate risk, liquidity, currency risk, I got a whole list here, political risk, and more. But what you have to try to do is minimize these risks to the degree that you are comfortable with. Some people are really comfortable with high risk because they think they'll make more money on the upside, and many do.
Living dangerously.
Yeah, and people do, especially when they're younger, because you have a long time to catch up if you made a mistake. The older you get, generally, the less risk you're willing to take because you're closer to retirement, and if something goes wrong, you can really hurt yourself.
I feel like I'm getting to that phase already. I don't want
Retirement?
no risks.
Closing to
I
retirement.
want no risks. No risks.
Well, you know what? I was always a very low-risk person. I never wanted to take big risks. I never had an investment which was a high risk. If I'd rather my money go up a little bit at a time than go
Then you
down.
lose all of it.
Losing all of it is kind of hard, although it's possible. But even to have it go down, just not something I like. And I have always maintained a kind of a towards the lower end risk of investing.
I have always been a conservative, but I like a little bit of play.
In terms
And
of
as far as investing, I would never invest the bulk of my portfolio, if you will, into anything risky. But I do recognize that if I'm willing to go to Atlantic City and throw some money out on that, I can do that with stocks if I'm going to stay home. So if I have like an extra couple of $100, I'll throw it in the stock market. If I lose it, it's like lottery tickets to me.
And
He thinks that's just silly.
How
It's
was
almost
your...
like a lottery ticket. That's okay if it's a lottery ticket or
Yeah, if
or
I
a
lose it
cryptocurrency.
all-
I mean, if he's doing it for fun once in
Yeah.
a while.
That's
Exactly.
It's like going out to dinner. Fine, that's nothing wrong with that.
And how was, I remember the last time you were talking about your experience during COVID. How was your experience managing that risk?
Well, I still have some money left.
In that account.
Hopefully it's gonna
less
go
than
up.
half of what I put into it. It's like 35% of what I put into it.
But you didn't get COVID.
I didn't get COVID.
You never got
It was like
Count
a
your winnings.
long weekend in Vegas.
Wait, you never got COVID?
Right.
No,
No, actually,
neither is-
I did. I had a very, very mild case of it. Remember in December, right around the,
tested
we were actually supposed to be going to Las Vegas, and he started feeling bad, and I said, "Let's cancel now." Before, and as soon as he got through it, I got it, and it was right as we would have been leaving for.
But it was not. I mean, I went to
We're
work
very
every
mild.
day. It was
very
as-
mild. It
as
just tested.
mild
We
as could
tested
be.
positive on the.
Yeah, me too. I tested positive, but
Yeah, nothing.
I actually knew that I had it when I tested to see if you already had it. So it
Oh,
was
that's
gone
right.
already.
This, you realize, has nothing to do with investing, right?
Exactly.
Okay, so back we go.
You know,
We're just such interesting people.
right?
So
What are these risks? Hold on, because we're talking about risk. Okay, but what is a risk in this?
A risk is, and I listed the whole list of possible risks, but because of the level of risk in what you're investing in, you can lose a little, you can potentially lose all of it, or with a lower risk, you can make less, but probably not lose, or lose much less if the whole market goes down. And there are several ways to minimize your risk. You can't get rid of it. There's always going to be risk. But to minimize it, one of the first things you do is diversify. You try to invest in a broad array, whether it's a mutual fund, whether it's stocks, bonds, or a mutual fund. If it's stocks and you insist on investing in stocks, you're wrong. However, it's your money and you're allowed to do what you want with it.
You'll maybe have a lot of people disagreeing with you on that.
You may.
We'll see.
I may.
Comment. Take a
yes.
moment to comment if you disagree with Drew, if you agree with him. You know, what are you thinking? What are your
But
thoughts?
Doesn't make any difference. He'll never change his mind, but you can
I won't
disagree.
change my mind, but I'll listen to you. And I certainly believe everybody has the right to lose all their money. That is your right. It's not my right to tell you how to invest or how to live your life. I'm giving you general principles of investing.
Disclaimer.
And you take them or don't. I'm not here to tell anybody how to live their lives or
Period.
what to be doing with their money or any other part of their lives. Therefore,
Okay.
diversify what you own. If you're investing in stocks, make sure you have a little of each area.
So that's what diversifying, like the term means, to have different.
Yeah, whether
types
it's
of
in industrials and
investments.
technology, real estate, mining, automobile, aircraft, soft drinks, drugs, this should be
Cannabis.
here too. Cannabis, absolutely.
I have a question. Sorry. So isn't a mutual fund already diverse?
Yes.
Yes.
However,
stocks.
yes,
And-
there are many mutual funds. Some mutual funds have a larger percentage of higher risk stocks in their mix. Those are higher risk mutual funds. The chances are, if you do well, you'll make more than if you invest in a mutual fund which has lower risk stocks. But the chances of losing in a high risk investment, high risk mutual fund, is greater than in a low risk.
I'm trying to think. There's different things, like there's the growth, and then there's the
There's growth, there's income producing.
there's like three, aren't there? I can't think what the
To
third one-
measure a stock?
They're defined with different terms. There's a growth stock, meaning it's going to increase more. Then there's one that's more conservative, and I can't think what the term is.
Lower risk, or
Okay.
the fact is, they don't really know.
It's a guess.
Growth versus income.
Mm-hmm.
What does that mean? Unless they're talking about dividends, some stocks pay dividends, which are payments based upon their profits, usually once a year or 4 times a year. Those are income producing stocks. Mutual funds, I've never heard of a mutual fund that pays you dividends. You just invest in it. As it goes up, or goes down, it goes down. So income producing, I guess with stocks you can call them income producing because they're
Well, I was just saying
they're gonna
growth.
pay
I
you.
remember hearing the term growth.
and growth means they grow, that they make more money. But
And the question that I'm pretty sure that all of our beautiful followers or beautiful Richies or whatever you guys will be called is probably how to start. I feel like I even have this question because
well, we will get there. It's on the next page. I haven't yet turned the page because we're
Oh, I
still
didn't
talking
know.
about risk.
Don't get ahead of yourself.
Because we're still surprise.
there's organization.
There we go. I'm the organized one in the
professor.
family here. We have to continue with risk. Not that there's too much to go. It's very important that you decide how much risk you can handle, which we said in the beginning, I never could handle some. I know people in their 50s and even 60s in really high risk investments, and I think they're nuts, but that's their right. You have to decide. I look every day when I get to work, the very first thing I do after making coffee is look at my portfolio
Every day?
every single day online, 7 days a week.
How
even
has
though
it been
nothing
lately?
happens.
This year?
This year, oddly enough, where since I'm in a conservative sort of low risk investments, it has not changed much. As a matter of fact, it has gone up
Yeah.
a little bit.
So you didn't lose as much.
I didn't lose anything. It's gone up, like let's say 2 or 3% from January to now when we're
But
in.
when you,
June 1st.
last year, it dropped.
No, the year before last.
2 years
The year before last, everything dropped. It was post-COVID still, and it was.
But I heard that this year, when the new administration took place, I heard that a lot of things fell.
A lot of things. Doesn't mean
Drop.
everything.
Doesn't mean everything, and it also the new tariffs, which they're talking about, which may happen, which may not happen, nobody seems to know because every Tuesday and Thursday it changes, have caused the market to take huge increases. And then the next day, the tariff said, well, okay, instead of China having 150%, it's going to have, 25% or 10%. Next day, it started to make tons of money as soon as he dropped the tariff. So it has gone up
Very
and down
volatile.
and up and down, very volatile in the past several months. My low risk investments are ahead of where they were on January 1st. Not giantly ahead,
Interesting to know.
but probably, I would say 3% above. And that's 3%, and there's still 6 months to go in the year.
How about you, Michael?
Well, we are actually in the same
We have
fund.
the same.
Oh, you
I'm
guys
following
have the same
We have the
portfolio?
I follow his advice.
It's
That's
the-
my
yeah.
that
Yes,
is my
his own.
retirement.
It's his own, but it's the same portfolio.
Yeah, we have the same stock holdings portfolio.
Oh, it's not the same. You guys
We have separate accounts,
We have separate accounts,
but
the
it's in the same.
okay.
but it's in the same different.
And you said it's Vanguard that you use?
It's the Vanguard funds, and there are many funds in Vanguard, which we should discuss.
Next.
If you're interested in investing in stocks, specific stocks, individual stocks, after I shake my head and go, be sure you read about the companies. Won't give you all the information, but it'll give you some. We said in the last episode, you can be in a company, invested in one company, which is doing very well, and suddenly comes up with this gigantically popular drug, for instance, and makes some billions, but it still that drug represents such a tiny portion of the whole company that your stock doesn't, rises 2%, which is fine, better than losing 2%, but it's not a ton of money. There really is a lot to know, and if you invest in individual stocks, you better do your homework and study and figure out what you're talking about and what you're investing in, as opposed to saying, oh, cannabis, that sounds like, you need to know something about the company or companies that you're investing in. So never learn what you have to learn and never take more risk than you can handle. CDs are one of the few near zero risk investments. You can open them up for 3 months, 6 months, a year, 5 years, 10 years, longer. They will guarantee you a certain rate of investment as long as you don't take them out. And by and large, if they're with a major bank, for instance, there's no cost to getting them. And if you don't take them out before the due date, you will earn the percentage that they tell you. However, that percentage, I think at the moment, is somewhere in the neighborhood of 6%, 5 or 6%, probably closer to 5.
For how long?
Per year.
So if you leave your money
invest
there for your year.
for a year. So if you invest in a 6-month CD, it'll pay you half a year. It'll pay you 2.5% of the it'll pay half of the 5%. Whenever they give you a percentage of increase, it's per year. Long term, nobody knows.
But if you have a CD and you decide that you want to have, say, $10,000, use this round number, you can put $5,000 in a shorter term and $5,000 in a longer term. And that way, you're not locked into the same rate for a long time. I did that a couple of years ago. I had $10,000 and I put one at 6 month and one at 1 year. The rates were around the same, but my feeling was if the 6-month period, the interest rate went up, I would have just reinvested at a higher rate. I wasn't locked into it. As it turns out, that didn't really change, so it wasn't a big deal.
Are you done?
I'm done.
Sorry. The bottom line is be very careful when you invest, understand what you're investing in, and be careful who you talk to or who you listen to on a podcast or on TV or on the radio.
Just us.
Just listen to us, exactly.
Well, what it is that most people have a bias. They lean towards some type of investment or some specific stock. Often they won't tell you that that's their bias, but they'll give you a very strong argument for buying that stock or buying that fund. But it's because they have a bias as opposed to because it's really a great stock.
Right. Well, everybody has their own experience, their own opinions. Some people have a financial whatever. If they get you to buy that, they make more money. Or if it's something that they're investing in, they want everybody to invest in so that the value goes up.
Yeah, that's a very important point. Many brokers, different kinds of brokers, will get a bigger percentage of the sale if you buy a certain stock. Well, you know they're going to push that stock. The only exception in a certified financial planner is a fiduciary planner, CFP, Certified Financial Planner, who gets paid a fee in order to guide you. And as a rule, those people are more likely to give you unbiased advice because they're getting the same fee.
Yeah, that would make sense.
But there are always the Bernie Madoffs of the world.
Let's talk about who Bernie Madoff is, because a good portion of our audience will not know.
Bernie-
He was a guy who got a bunch of friends and coworkers to invest in his company and promised them these huge rates of return. And what he did was he gave out little bits of returns for certain people to sort of tempt other people. By the time he was caught, what was the number you said?
By the time he was caught, he never invested the money.
Yeah,
That
he
was
kept
the-
it, but he made it
kept all
look
the
like,
money.
because
Didn't
everybody kept
invest it.
giving him, so he would pretend to give out a little bit to this person, a little bit to that person. So people kept giving him more and more. And these are like big shot, multi-million-dollar charities, celebrities. The amount of
And his family,
yeah,
that
they
was
didn't know
involved
about
in
it either. They got involved in it, thinking that it was legitimate.
And he's actually stole $15 billion. If he would have invested all the money he was telling people he was investing, he would have had $185 billion.
How are people so stupid to not notice it before?
Because he was a legitimate businessman, and because he had a good reputation, even the federal whatever, they were investigating him. He made it so complicated that they believed him.
He did it, by the way, forever.
He did it for
30
years and years. I mean, this was not something that he did suddenly. And the number of charities that went complete, left everything. I mean, there's a number of celebrities on the list, but he was Jewish, and a lot of his stuff was within the Jewish community and charities that related to the Jewish community. It was horrifying. His son committed suicide because they were really, really unaware that this was
He
going
went
on.
to jail. You didn't
And
say.
He went to jail and then died
in
in
jail.
Yeah.
Oh, okay.
But his whole
But he was
family
old.
was
He was
How
mortified.
long did he stay in jail? And
Well, he died. He was in his 70s when he went to jail. So he, I don't know, lived 5 years in jail, maybe 4 years.
Maybe.
in
I mean,
jail.
he made it to jail because there were a lot of people who just wanted him dead.
Oh
He
yeah.
was-
Oh.
So his name is associated with fraud. If you hear a Bernie Madoff, it means that this is someone
He
who
is-
is totally fake.
And what he did was a Ponzi scheme, which was named after Ponzi, a guy named Ponzi.
Who had done it many years ago.
had done it a very long
So now
time
it's a
ago.
Madoff scheme.
And yeah.
so we are not so naive as
And you
the
can't say, how did nobody know? You give me money to put in your savings. Who knows what I'm doing with the money?
You have to make
Who knows?
educated guesses. And this was a gentleman who had
That's-
been around and had great credentials. And the government investigated him. And the government decided he was legitimate.
That's why it's important for people to keep getting educated about finance, and that's why we're here. So if I were you, I'd advise you to
to know.
Follow, subscribe, like, keep on
Comment.
updated with us, you know.
But you really have to be careful because you just, by the same, and these are the financial advisors, by the way, he and those like him, who you have no control. You give him money, and he says, I'm going to give you 10% a year or 15% a year, well, probably 10% a year return, guaranteed, maybe more. He does whatever he wants. You give him the money, you're done. Those kind of financial advisors and investors have always scared the life out of me. I have never used one. But my brother-in-law and my sister used somebody for many years who was known in the community, and my brother-in-law just retired a couple of years ago. Plenty of money to live
Nice.
3 lifetimes on. The guy was as honest as could be. And most are honest. I assume most are honest. But boy, if you have one who's dishonest, he left people with nothing. He left rich people with no money.
I just want to say we're talking about risk here, but we should also give people some insight into how to do this.
How to start investing.
How to start investing. That was what we were supposed to be talking about. It's way more
Kind of got
topic.
excited
It's just
there.
much more interesting to do to talk about this. So you have to decide how you're going to start to invest and how much you need. You don't need a lot. If you have $100, feasibly you can. Ideally, $1,000 minimum is kind of the number people talk about. But you don't. If you don't have it, it's better to invest $100 and make a tiny little bit of money.
Why don't you tell your audience to save $1,000 to start and then decide?
Well,
what
I
to
mean,
do
the fact of the
next?
matter is, if people have a goal, they can do it in bits. Our point of view is if you start the process, no matter how much, if you save $1 a day, if you save $5 a day, if you save any movement in the right direction will get you there, but it may take you longer. So if the best you can do right now is $10 a week, save $10 a week. Maybe in a month you can save $20 a week. Or over time, it becomes more of a habit. We've talked about this before. Consistency is very important.
You're right.
And the reason you say, why don't I say $1,000? Because there was one kid we met in a clothing store who, a young little gay boy, just the sweetest thing ever.
I
and
remember this.
Just so sweet. And we were talking to him about this. We were about to do the podcast this a year ago. And he said, how much do you need? I said, well, ideally $1,000. You could see his eyes glaze over, like, I don't have $1,000. I'm never going to have $1,000.
Oh my God,
And
no.
it was done. And that taught me, don't ever say $1,000.
Yeah.
If you have if you don't have $100, you got a whole other problem. But if you can invest $100, start with a CD, start with something.
So there are CDs that are $100.
Absolutely.
Oh wow, that's
Absolutely.
good to know.
You can go but you want it in a place. I'm sorry, I interrupted. You have to go to a reliable FDIC insured place, which means the government insures it, like a bank, a major bank. And you want to buy a $100 CD for 1 year at 5%, they'll do it.
One of the things that I've done is I go online and I'll just type in what is the best CD rate I can get. And it'll give you a list, and then it'll show you whether those CDs have minimums. Some of them do have a minimum. Some may be $10,000, depending on where the investment is going. So once you figure out that there are some that have no minimum, that's where you can start.
My question is, those that you're looking, do they say if they're insured or not?
Well, that's assuming that you're going to a regular bank. You always double check, but that was one of the things we talked about earlier, which is the FDIC, which is Federal Deposit Insurance Corporation. You want to make sure that it's protected, that it's a legitimate bank, because there are certain things called credit unions that are like banks, but they have a different.
Some do, some
Yeah,
don't.
some of them are very good, but they're not as protected as something that is an FDIC.
Which doesn't mean you lose your money. But
No,
it means
doesn't
it
mean
doesn't
it's not-
have the government's guarantee behind it.
Which we all want.
Which you should want. You should want. So ideally, if you have a small amount of money, putting it into a CD doesn't cost you anything. If you want to invest in a mutual fund or individual stocks, you have to find, you can't do that on your own. You can't call up Pfizer and say, I want to invest in your company. You have to go through a broker or a brokerage house.
Or an app. Nowadays, there's apps. You can do it.
Well, I don't know
Because I have
If the
used
apps are insured or not insured, what kind of insurance the apps have. If they have FDIC insurance, or what kind
I
of
don't think.
guarantees.
Do you remember about the Robin Hood scandal? You have to. That one. That was very.
You can teach
recent.
us.
Yes.
But I kind of don't.
What is the Robin Hood?
You got to do your
Oh, you
research.
don't need this.
Well, no, I'm gonna send you the Netflix show. I have to rewatch it. But basically, like people would, like they kind of broke this app thing because it was when.
Oh,
the,
I know it was
the
the
GameStar
Games-
app
yeah,
was
Game
Oh,
happening.
game
right.
something.
Game Shot.
Yeah. Yeah, I know what you're talking, but that I don't know what.
GameStop, I
And
think
then
it
the
is.
Netflix show explained how these people trading through apps, they're actually customers and they're not actually, like there are people above all these people who are making money, like cents by, like little cents by transaction, but there's trillions of transactions happening at the same time, so they make a lot of money.
But the GameStop thing was that a group got together and
And they
bought so
started-
much stock that it brought the stock up enormously from 10 to 200.
And some people got really rich and some people
Well,
got
because then all those people who brought it up, everybody else was, they were telling everybody, they see it going up
They
every
sell.
single day. They sold it all, went down to 2. And everybody except that group, who made tons of money, lost everything they had.
And they were
lost
little investors. They were
90%.
not like professionals. It
Right.
was just somehow they got organized with some online forum and they said, let's do this.
Reddit. I think it was Reddit.
Yes. I think you're
Another
right.
argument for not buying individual stocks. Just one
Anything
more.
else in terms of beginning to invest?
Well, beginning, so with CDs through a bank or or it can be online as long as it's through an FDIC insured agency, you can invest with a little amount of money. Insofar as mutual funds or stocks, you have to find a brokerage. For instance, Vanguard, which I use, and I'm not touting them, I just think they're reliable. There's
It's
Fidelity.
not sponsored. It's not
No.
sponsored.
No, it's not sponsored.
Yeah.
If they want to sponsor us, by all means, they should give me a call. But there's Charles Schwab, there's Vanguard, there's Fidelity, JP Morgan Chase, there's E-Trade online, Morgan Stanley, Merrill Lynch, Chase Bank, TD Ameritrade, many.
So all of these banks can be used to invest.
To,
Sorry.
to open a brokerage account. Most of them will have a no-load fund. You don't have to put any money down other than the money you're investing. There's no fee. There's no significant fees. Some of them, depending on how low, if you really want to invest just $100 or $500, may charge you a small fee. I don't recommend the fee, but I do recommend very highly that it's a way to begin. Because once you begin, it's like Michael says, it's like going to the gym. You just kind of get in the habit
Of what? By
putting money in, of
It's-
putting
yeah, it
money
becomes
in
part of your
weekly.
routine.
He now has money taken out every week from his
Yeah,
paycheck.
you don't miss it. It's just part of your
It-
expense.
you take it out first, and then you spend whatever's left. And that's a very smart way to do it.
This is more an personal question. So when I have my RIA account, IRA
Individual retirement.
Okay, this is embarrassing at this point. Rewind. Delete that. So when I have my IRA, I can tell my job to take that money
No,
straight out of
you
my
can
paycheck.
take your own
You do
money.
it yourself.
You tell their bank to take it out.
Yeah. If
Your-
it goes
your
into
check
your
goes into your bank. Go ahead.
yeah. Otherwise, if your company is doing it, it's what they call a 401k, and that's a whole system through your job. That's one of the benefits you can get because it often means that what you put in, they double or a percentage. I don't know what the numbers are.
Okay, so when I have my IRA, I can tell my bank to go and be like,
Take every week, I'm going to get a check for X amount or whatever I get. Take $100 out or $50 out and put it into whatever.
Period, guys. See?
And that's the way you force yourself to begin saving. And as I've said many, many times, if you do that, if you
Tell them.
put in $3.33 a week,
A day.
a day, $3.33 a day
IRA.
into your IRA is $100 a month. When you're 25, you do that, just that amount of money, and you'll have over $1 million by the time you're 65.
Assuming you're going to live until then.
Of course.
So make sure to balance a little bit.
What kind
you
of
know?
thing is that to say?
Now we're
assuming you're
getting
gonna
into a
live
whole
until
different thing.
Make
But
sure
we
to
should,
balance a little
we should
bit.
wrap up.
In any case, just be careful about what you're investing in. Be careful if you're going to let somebody else run your investment. Be sure to monitor your investments regularly. If you don't want to look every day, look a couple of times a week. You want to see what's happening. It keeps you more involved. It keeps your head involved. And if you can do it by having the money taken out of your check and put into an account every week or every payday, you won't even feel it. You really won't even feel it.
Let's make the momentum, get the energy, make that a hobby. It's me talking to myself as well. Make that a habit, like hobby and a habit to look at your account.
And so the first thing you
Putting
want to do,
money there.
but before you do that, you want to be sure your credit cards are all paid off because you're paying 20%. No investment that I know of is going to guarantee you 20% a year in profit. But you're paying 20% for those credit cards or more.
Life is crazy. The percentages of interest on credit cards are so much higher than any type of investment
That you're going to. There's a reason for that. We're not going to go into it now, but nonetheless,
keep us broke.
if you pay,
What is the reason?
Well, it's because they are in the business of making money.
With money.
Yeah. You're in the business to catch up, and they're in the business to take advantage of anybody
and there's
who's
no
spending money.
guarantee that you're ever going to pay them. It's an unsecured loan. You don't have your house like a mortgage, which holds you to pay, which they have in their name. So you really are in a position where the bank is really or whoever gives you the credit card is in a position that they're loaning you money with absolutely no guarantees.
That you're going to
But
pay.
in any case, pay off your credit cards first. And if you have an emergency for a few months, you'll have those credit cards paid off for that emergency, or pay the credit cards off, then start saving. You can do it through your IRA. You can start saving for emergencies, and then the rest is complete investments forever till you retire.
Period. And this was one more episode of Rainbows to Riches. Unless anybody else has anything to say, we're all done.
We're tucked out.
This was our version of risks and how to start investing in stocks, bonds, CDs, and mutual funds. I hope that you guys liked it. Make sure to engage with our video if you like our content so we can spread it out more. Make sure to like.
Comment?
And subscribe.
You almost
Period.
you forgot your line.
You got it. Thank you so much, guys. See you in our next episode.
Thank you very much. If you have any questions, please feel free to let us know. And remember that this podcast is for entertainment and information only.
If you want to work with us, if you want to be an intern, help us with social media, whatever, let us know. Comment down below. Thank you so much.